Hello, my name's Craig Earle, market analyst at ALPARI UK, and welcome to our daily market update. Today we're going to start by taking a look at that fourth quarter GDP figure out the UK, which came out at minus 0.3, slightly lower than we were expecting, but in line with that NIESR GDP figure which was released a couple of weeks ago, so there wasn't too much of a shock in the markets to this. We did see sterling weaken shortly after. However, all in all, I think this was largely expected. Now, there's going to be a lot of talk about what's driven us back into this contraction figure, and I think the reason is the fact that we had such a strong third quarter driven by the Olympic effect. What we've actually seen is we've seen a drop off from that, and that's resulted in worse figures, lower spending, and therefore resulted in this contraction figure in the fourth quarter. I think the thing that people are going to be most concerned about now is the fact we are at risk of the first ever triple dip recession in the UK, and the fact that we've seen such bad weather in January and all this snow isn't going to help matters. History would suggest that this does tend to have a negative impact on the final output figure, with people choosing to stay home rather than go out and spend, and we know that consumer spending drives about 70% of GDP in the UK, so if people are staying home, this is going to have a severely negative effect on that final GDP figure, so there is going to be that higher risk that we are going to fall into that triple dip recession in this quarter. I think in the bigger picture, I think the figure that gives us more of an indication as to how the UK is performing at the minute is that year-on-year figure. Now, this came out at 0%. Again, not really too much of a surprise. We have had pretty negative data in the UK, and we are going through that period of austerity with George Osborne's deficit reduction plan, so it doesn't really come as too much of a surprise, and I think we're going to see largely the same thing in 2013. I think we're going to see growth this year between 0 and 0.5%, so nothing really to write home about, but I think this does really tell the bigger picture, and now we're going to have this first quarter where there's going to be a lot of focus around George Osborne's deficit reduction plan. We are seeing him miss targets. The deadline's already been put back by 2 additional years, and we are now at risk of losing that AAA rating with the UK on negative outlook with the 3 major credit rating agencies. Charts now, you can see that the pair is trading lower off the back of this poor GDP figure for the UK. Over the last couple of days, we have seen it break that key support level where the neckline of that major double top movement crosses with that 50 fib level. Now, based on the fact that we have seen a break of that neckline, it would suggest that we are going to see a move back towards 153.50. However, if you take a look at the longer term chart, if we take a look at the weekly chart here, you can see that the pair is fast approaching that long-term ascending trend line dating back to January 09, and I think this is going to provide a key level of support around 157. If we take a closer look at the recent price action, you can see that this ascending trend line actually crosses with the 61.8% Fibonacci retracement level, which is going to provide additional support for the pair. So I think it's going to find it very difficult to break below here, and I personally don't actually see it breaking below here over the next few days. I think we're going to see it bounce off this level before trading higher. Next, we're going to take a look over at the Eurozone, and this morning we've had the release of the German IFO business climate figure. Now, this came out once again much better than expected. We've seen a lot of that this week with Eurozone data. We've seen the ZEW economic sentiment figure for Germany and the Eurozone easily beat expectations in the week. And then yesterday we saw the manufacturing and services PMIs also beat expectations. So we are seeing a significant improvement here. And the good thing about these business surveys is they do tend to give you an early indication as to what we can expect from the economy over the next 3 to 6 months. So this is a very positive sign for the Eurozone, and it would suggest that we have seen the worst of the debt crisis in 2012 and that 2013 is going to be much better. And it also suggests that we could actually see the Eurozone move out of recession in 2013, as Mario Draghi predicted, maybe later on in 2013, maybe even in the last quarter. Finally, the ECB announced this morning that banks repaid 137.2 billion, or are due to repay 137.2 billion of those LTROs on 30th of January this month. Now, there's really 2 ways of looking at this. We've seen a positive reaction in the markets due to the fact that people see this as a good sign that banks' financial situations are much better now, their balance sheets are much better, therefore they can afford to repay these loans. However, you can also see it as the fact that the original intent of these loans was to try and get this money filtering through to the real economy. And if so much of these loans were already being repaid and we're expecting another couple of $100 billion over the next few months to be repaid, then is this actually happened? Has it been filtered through to the economy at all? Are banks using it in the way that they should, or have they just been keeping it on hold, keeping it on their balance sheets for the last 12 months or so, and are now just repaying it back? So it would suggest that the banks haven't really used this money in the way they should. However, like I said, on the more positive side of things, it would suggest that their financial situations are much improved, and that's what we're seeing reflected since this data was released. We are seeing stock markets trading high. We are seeing a positive reaction to this. For more news and analysis, check out the ALPARI newsroom, which can be found at www.alpari.co.uk/newsroom. And you can also follow us on Twitter as well. My username's Craig_ALPARI UK. And you can also follow the ALPARI Twitter feed, that's ALPARI.FOREX. Thank you very much for listening and have a great weekend. My name's Craig Earlham, market analyst at ALPARI UK.